Welcome to the show, Mark.
Well, thank you, Michael. And I am back to wearing some socks. So we'll do a quick reveal. Although today is kind of an optimistic day. I am wearing the Bitcoin Moon socks. When moon, and that's not to say that we're going to the moon. It's not to say I'm actually heading to Austin to sit on a panel tomorrow morning for Consensus. And I think the optimism of 20,000 people showing up to talk about this stuff is good. I just wish we actually would stop talking about just the price. And I think you tweeted out, or Yano tweeted out. Wait, I'm not supposed to say his name. He who shall not be named. Might tweet out that it's just about building, right? This is the time to focus on building stuff. So, anyway.
Yeah, I would have to agree with you. Mark, I think we'll know that we made it on this show when depending on what socks you put on, that actually moves the market. When that starts to happen, when we get a legitimate bump from whatever you think
that's right.
Socks are, that's how we'll know we made it. I'm glad we started optimistic. 'Cause we've got a slightly worrying story that we're going to talk about. We're going to be talking about consumer credit and the personal savings rate. So give me
savings, oxymoron.
Yes, exactly. Over the last couple of months, obviously on CPI, but there was another very important number that came out this week, which is consumer credit. So what we're looking at here is total consumer credit. That's denominated in billions of dollars. And it's broken out between revolving and non-revolving credit. So you can think of non-revolving credit that's one-time credit events. That's like, auto loans. That's, student loans, things like that. Whereas revolving credit is something like a credit card, and that's an account that kind of just stays open, right? That's perpetually open. This has steadily been creeping up, since basically the pandemic. You can see an enormous, deficit in credit flows, which is basically when the consumer was repairing their balance sheet, they were actually paying down their credit cards in March and April of 2020, when they were really worried about the economy and the world and everything like that. And since then, it's just been a straight line up in the other direction to last month, which was a record month for consumers basically spending on credit. And the reason why this is worrying is if you put these two charts against, so we've got total revolving credit on the left here, which is basically at an all-time high. And then you've also got the personal savings rate, which is the amount of money that people keep in their bank accounts, heading to an all-time low. And you can see that these are inverses of each other. Again, that spike that we're seeing in this chart on the right lines up to this dip here on the first chart, which is basically when people were paying down credit cards, they were repairing their balance sheets. And now it seems like they're being, they're kind of doing the opposite, and they've essentially tapped out their bank accounts and are starting to spend on credit. So I guess, Mark, when you see these two charts together, what are some of the first thoughts that come to mind for you?
Well, the first thing is it was a natural reaction for an over-levered consumer to take some of the free money that was handed to them by the government and pay down debt. The smart consumers did that. Now, there were plenty of people who didn't, that sent the money off to Robinhood and E-Trade and tried to gamble in the stock market and felt really good when the meme stocks went up and now have lost everything. So that didn't really help. And now they're having to really dip into savings, well, what little savings the average person has, and spend on credit cards. And this is a really bad. I don't want to be overly dramatic. I'm prone to hyperbole, but this demands hyperbole. This is a crisis. And, as we were talking pre-show, I'm afraid, I really am afraid that this is not unintentional, that this is an intentional crisis. I tweet about this relatively often, the dictator playbook. When countries get behind the eight ball, where they get overly indebted and they become crony capitalists, or even worse, cronies or kleptocrats. And you get this group of people at the top who, they're super rich and they own everything. And what they realize, the only way out of the mess is to devalue the currency and therefore impoverish the masses. Well, how do you impoverish the masses and stay in power? Well, you got to give them stuff. You got to pay for votes. So you got to forgive student loans and you got to give free money during the pandemic. And that's what we are seeing. And it's not surprising that if someone hands you a check, you look around the house and you say, geez, I owe a lot of my credit cards and I'm a couple months behind on my mortgage. And, there was a period where you didn't have to pay your mortgage, right? That they basically said you can't be evicted. You can't be foreclosed on. So everyone just stopped, not everyone, a whole bunch of people stopped paying their mortgage, stopped paying rent. And then that went away recently. And now suddenly it's like, okay, I got to pay the mortgage and I got to pay. So the only way to do it if you don't have cash is to borrow. And we still, for some unknown reason, we still give uncreditworthy, and that's a harsh term. I mean, they're perfectly nice people, but when uncreditworthy just means you don't have the capacity to pay back the loan. And Michael, this is the thing that's been going on for decades is, when I was growing up, my parents, they knew the banker, right? The banker lived in town and there was a relationship and they lent you money based on what was called hedged finance, right? Bankers lent money with the expectation, right, of getting paid back both principal and interest. Novel concept, right? And you were hedged by the asset that you lent against, a house or a car or whatever. Well, then, the big banks kind of took over the small banks and the bankers were no longer in your town and you had the big nameless, faceless. And then we moved into speculative finance. And this was kind of the 90s into the 2000s. And not only did they lend you expecting to be paid, no longer did they lend being expected to pay principal and interest, but now as long as you could pay the interest, right? As long as you can pay the interest, well, that principal, we won't worry about that. You'll sell the asset at a profit someday, except for cars, which depreciate, or boats. And so then we got into where we are now, which is Ponzi finance, where the lending's going on with no expectation of paying principal or interest. That there's just going to be a lot of defaults. And they kind of build it into their models and they jack up interest rates. Revolving credit is not, do you borrow at Fed funds? I always ask. I don't seem to borrow at Fed funds. And no. I think credit card interest rates are still 20-ish%, maybe higher in some cases. So this whole idea that interest rates are low, well, not for this type of credit. And this is the super highway into economic misery. And that's why the misery index, if you ask the average person how they're feeling right now, I just saw this morning, ugly. 80%, I think, said that they feel we're going in the wrong direction.